What's going on, everybody? This is Andrew from DeFiancy. So today we're going to talk about a lot that's going on in finance, specifically the bond market and the equity sell-off that's happened over the last few weeks, really the last few months. We're going to talk really about kind of the opportunities that are being presented here, some of the risks, and kind of a little bit of a slight macro. Look, we're not going to get too deep into the macro here. We're a prop firm, and we really just want to look at the opportunities in more of a shorter term basis. But I think this video, or I guess this turning point in the market that I think we're about to be approaching warrants somewhat of a medium term macro view going into the end of the year. We're going to talk about I think things you probably are not going to really see that much on Twitter or on CNBC, which is very obviously pessimistic. A lot of people are really capitulating at this moment when it comes to the bond market. But let's talk a little bit about kind of where we were over the last few months. So the best place to start here before we go into bonds is let's look at the S&P 500. So here's the S&P 500. We basically put in somewhat of a double top earlier in July, and we've had this steady downtrend really since then. We tried to get back above close to the highs in September. This was around the last FOMC meeting, and we've had a pretty gnarly sell-off since then. Okay. Now, if you look at this from the perspective, I think of let's call it Twitter or CNBC or just the average person on YouTube, there's a lot of panic in the streets, a lot of concern here. Now, I actually don't think that it's quite as bad as people think. So right now, again, you're looking at the S&P 500's futures contracts, and we're approaching the 200-day moving average, which is really, I would say, my line in the sand. Once you get below that level, you should definitely be concerned if you close below that level for more than a few days, or especially if it's more than a few weeks. But so far, we're above it. And if you look at the Nasdaq here, this is a really interesting situation. The Nasdaq hasn't even made a new low. It's nowhere close to its a new low in terms of from its sell-off at the high here, which is showing you something interesting, that people are actually bidding up the Magnificent Seven, as they call them, the big tech stocks. And there's some reasons for this, okay? The reason is, and we can talk more about this later, but I guess I'm going to go ahead and go into this. This right here is a chart of the average movement of the S&P 500 from a seasonality. So if you're looking at this, you see that typically September and October are not great months for stocks. Typically that's when you see a lot of selling. And this time period is usually pretty infamous, or is infamous, for big market crashes like in 2008 and 1987, I think 1997. There's been a lot of really, big pullbacks in the market during this time. And there's some reasons for this. But really what I want to point out here is this is very seasonal. And if you look at the other side of this, assuming that we stay in this kind of seasonal, following these seasonal trends going into the end of the year, that is typically a better time of the year for markets. And I find this kind of interesting that this big move up that we had in the S&P 500 this year was really, again, 7 stocks. Excuse me, the Magnificent Seven, as they call it: Google, Facebook, Amazon. Obviously Nvidia is in that mix too. But most stocks, if you actually look at like some of the smaller cap stuff, is like flat for the year. So unless you only bought those stocks as a portfolio manager, you didn't make any money this year. So a lot of firms, a lot of investment groups are down for the year, or flat, or probably didn't make all that much money. And this is going to set up a really interesting situation, because now you have blood in the streets and you have a pretty decent buying opportunity. And I think that you're going to get people chasing performance gains going into the end of the year. They're going to want to show some gains to their clients for the fourth quarter. So I'm actually pretty optimistic going into the fourth quarter. Again, we're a little early with getting bullish here, because we could have some continued sell-offs. I think people need to understand that there's going to be people who see this as an opportunity, and as the dust kind of settles from this recent sell-off, you're probably going to see some buyers step in my opinion. And one of the reasons I also think this is if you look at the global liquidity index, this is a very interesting chart. We've been consulting with people who are really good at global liquidity, tracking it and understanding kind of where it's moving, whether, within financial markets. And in my opinion, this has been the most accurate liquidity model that I've found. And if you look at this model, what it's telling you is that liquidity actually bottomed around October of last year. And there's some reasons for this. The Treasury started to basically push, or they started pushing money back into the markets, and this helped tremendously in terms of liquidity. But based off of our research, what we're really learning, and it's been a surprise to me, is liquidity is a very different. There's very complex levels in terms of, or let me just say this: most people do not understand global liquidity. And if you look at most people's opinion, they're looking at M1, M2 to come up with their thesis on if liquidity is going to be sufficient to support asset prices. Well, they would have been dead wrong, because M1 and M2 have been going down most of the year, and stocks were going up while M1 and M2 were going down. And there's a reason for that. It's most of the capital that's moving into the financial markets is not M1 and M2. That's kind of an old and outdated model based off of the research that we've been doing. Most of, or a lot of the liquidity is actually based off of, or coming out of shadow banks in the Eurodollar market. And again, I'm not going to go too deep into this because we're certainly not experts on global liquidity, but I don't think you have to be to really make a general statement that people have gotten it wrong in terms of liquidity and what that means for asset prices. And they're probably going to get it wrong again, assuming that we did have a bottom in global liquidity last year. The wind is kind of at your back going forward now, pushing you along. Now, this is more of this is a longer term cycle here that you're seeing, these ups and downs. And there's many cycles within each cycle, right? So here's a cycle bottom, cycle top. You notice how it's not a straight line. There is some variance within the cycle. And that is what we're experiencing right now. And this has everything to do with the bond market. If you don't know what's going on with the bond market, I think the best way to look at it is to look at TLT here, which is an index of longer dated U.S. Treasuries, okay, of 20 plus years. And this is a pretty good pulse on really what's going on. As you can see, absolute just wreckage, right, in bonds right now, specifically over the last few weeks. And I think this is a capitulation in bonds, and I'm not here to say that this is the bottom, but what I'm saying is that as a trader, when you see things like this, you have to start saying to yourself, okay, where is max pain? And this provides opportunities, right? Someone else's pain is going to be someone else's opportunity. And based off of our research, what we've really come to realize is it's not really just the bond prices going down that's actually the issue here. It is what's called the term premium, which is how much lending can be, or how much you can borrow on your bond collateral. Before 2008, you had uncollateralized lending. Okay, so if one bank wanted to borrow from another bank, they would basically just call up another bank and say, hey, let me borrow some money. And it was based off of trust. After 2008, after all the blow-ups, you started seeing what's called collateralized lending, and that's the predominant model, pretty much is the model now. And so what people are doing and have been doing is posting collateral like bonds and saying, I'm going to borrow against this collateral. And as long as that volatility is low, which is directly related to the term premium, which tells you really how much risk is associated with that asset or with these bonds, as long as that is low, you can borrow up a pretty good amount against that collateral. But as bond volatility increases, like what is happening now, you're not able to borrow as much, and you start having margin call issues. So basically, we're experiencing a margin call, a big margin call, a capitulation event for many of these people using bonds as collateral, which are large institutions and nation states. So we're seeing a lot of people basically capitulating, not by choice, because their collateral is insufficient based off how much credit they've taken out versus that collateral. Now, I don't want to get too much into this, but the global liquidity cycle that I just showed you is just experiencing likely just a minor dip, or you're probably going to see liquidity continue to come in after this is resolved. Now, again, we're not here to say this is the bottom, but as a trader, when I see severe pain in a market, I start to think, okay, this is probably getting close to a bottom. I mean, this thing is absolutely wrecked. I mean, you were down, over 2% just today's session. Just kind of like the law of probabilities, just like basic understanding of statistics, is you're probably not going to see too many more trading sessions like this, back to back to back. And once we start to see this reversal a little bit, I think equity prices are going to really like that. And it's not hard to make a case that going into the end of year, which is seasonally bullish anyways, is going to, this could be a great opportunity to buy some stocks here. Now, this is not financial advice. We're just looking at this from more of a short-term trading opportunity, a tradable bounce. Of course, always use your risk management. Of course, we will be. But we're really seeing this as an opportunity. And when you look at, the S&P 500 here, I mean, it still looks pretty bullish structurally. You're coming up to a major level of support, this 200-day moving average. And I think you're probably going to start to see some buyers step in. And once, again, the smoke starts to settle, bond prices start to stabilize, yields start to go down, this could look pretty good. And one of the signs that I think you might be starting to see a pivot point, the beginning of a pivot point, maybe you're in that 7th, 8th, or maybe even 9th inning of this sell-off here, is because the dollar, it didn't actually go up today. Let me see if I can find it. Or it went up barely today. It was pretty much flat over the whole trading session. And what that's telling me is this thing is exhausted. And we could start to see a pullback, I think, in the dollar. Now, I don't know how long that will last. Again, this is just more of a short-term forecast here. But I think things could, start to be looking good in terms of, getting back on, into a risk asset tradable bounce here. Now, one thing we want to mention here is crude oil. This has been a major problem for risk assets over the last few weeks because, the market wants to be reassured that we're not going to be stuck in, a reinflation cycle where inflation's coming back up and getting out of control. Obviously, as crude oil goes up, your diesel fuel is going to go up, your gasoline is going to go up, and this can contribute to inflation across the board. But to me, it does look like it's probably somewhat topped locally here. And look, I mean, don't get me wrong. I think longer term, crude actually looks pretty good, and we're definitely going to be wanting to trade this probably to the upside going forward. But from more of a shorter term perspective, I'm thinking maybe this is probably just going to want to trade around maybe 95 to maybe around 85 or something like that. So I don't think this is just going to keep going up and really cause significant issues to headline inflation, but it's definitely something to keep an eye on. One interesting thing to note here is, let me see if I can find it, is the Nasdaq. So the Nasdaq hasn't even made a new low versus, or it hasn't made a low past its previous low since this top here, which was in August, whereas the S&P 500 has, it's nuked past it. So this is very interesting. And a lot of people see this as, well, that's not good. It's going to definitely nuke soon. Well, someone is buying the big tech stocks, right? And I think that actually makes a lot of sense, to be honest. I'm not saying that this is going to hold and maybe it goes lower, but these tech stocks have done really well this year. And look, people are going to keep it simple. They're going to buy things that have been winning because that's just what, that's how traders think, right? Like winners just keep winning oftentimes. And I also think that, one of the reasons why it's doing well is you have earnings season starting next week. And based off of the preliminary data, it looks like there could be some decent earnings in tech stocks and some other sectors. So this is really shaping up to be an opportunity by my estimation. Now if those earnings come in terrible, this is probably, the Nasdaq's probably going to struggle. But based off the preliminary data, things look, somewhat promising from that perspective. So we're definitely more optimistic, I think, than most people here, or most people that are on Twitter or X now, CNBC and YouTube, right? But of course, look, we could be wrong, and if the wind continues to blow down, we'll join in. But for now, we're thinking this is more of an opportunity for a reversal here and to have a pretty decent rally going into the end of the year. One of the reasons why, the bond market has been selling off, obviously it's that collateral issue, but what kind of sparked it, right, is the Fed talking about higher for longer, right? So the Fed's saying, look, we're going to keep interest rates up higher for longer. And I don't want to get too much into this because, a lot of this is just conjecture and speculation, but I do believe that the Fed is not in a position to really do that. And the reason I say that is if you really look at the United States debt, sovereign debt, these levels are just unsustainable in terms of having to pay the interest payments on that with the dollar rising. The only way that you can really deal with this debt in the longer term, actually, by my estimation, I could be wrong on this, is really to have inflation. You kind of need to inflate that debt away. And I think that's going to be what the Fed is going to choose to do. They're not going to say that, right? But and by the way, we're going into an election year, right? I just don't think the Fed is going to try to hammer inflation as hard as people are probably thinking right now, because the inflation is beneficial to them, or it's beneficial to the United States actually to a certain extent, which I know it sounds really bad because it hurts Americans, it hurts people who save dollars, the middle class especially. But maybe I'm thinking a little bit in a conspiracy way here, but in my opinion, they really just do not have. I think they're bluffing. Let me just say that. I don't think they're going to keep rates up quite as long as they are saying. And the first sign of weakness in the economy, they're going to be talking about, lowering rates. So I think that the market will eventually front run that. I'm not saying that stocks are going to go to all-time high or anything like that. I just think that if people are really panicking because of what the Fed is saying, that's, you probably want to look a little bit ahead on, or look a little bit more deeper into it, in my opinion, on why. There's a lot of compelling reasons on why they're not going to be able to keep rates up as high as they're saying. Okay, that's just my opinion. I could be wrong on that, but I'm actually thinking that rates are going to come down next year, maybe quicker than people are thinking right now. So Bitcoin's still struggling on its 200-day moving average here. I don't really want to make a strong case for either direction on it. Volumes now are approaching or at 2017 levels, which means nobody's really trading this. There's really not a whole lot going on. And, I just don't think it's really wise to have a strong opinion on something that really doesn't have a lot of volume. I think it's just going to chop around and just be waiting for narrative, which we know, there's going to be a narrative next year. And of course, if the Fed starts to pivot and talk about, lowering interest rates, I think Bitcoin will definitely do well in that situation. But regardless of really what the Fed does, and this might be a little contrarian, as long as global liquidity is going up, that should benefit Bitcoin. That should benefit crypto in general. So we're pretty optimistic actually on crypto going into 2024. Okay guys, so we have a quarterly report coming out soon that's going to go more into detail into this kind of stuff. I just kind of wanted to get a video out, and so I think that's really all I want to talk about today. And until next time, happy hunting, friends.